Welcome back to Investing Talk Podcast.
Today we're looking at Nebius Group.
As usual, before we start, subscribe, like, and comment to this video to support the show. Okay, let's unpack this right away, because the company we're dissecting today sits right at the dead center of probably the most aggressive, heavily debated sector in the entire stock market right now.
Yeah, without a doubt.
We are talking about Nebius Group, ticker NBIS. They are an AI infrastructure builder. And looking at the data we have from March 2026, they were commanding a massive $22.90 billion market cap. But here's the hook, the actual number keeping analysts up at night. They're trading at a staggering PE ratio of 226.90.
Right, and that is exactly the kind of valuation that immediately forces you to pick a side. There's really no middle ground on a multiple like that.
No, not at all.
It raises this incredibly important question for you, the listener. If you're looking at adding AI exposure to your portfolio right now, are you looking at a company that is just burning through mountains of cash in the middle of a massive AI bubble? Or is this a hidden full-stack giant that's quietly building the actual physical foundation of future GPU clouds?
Yeah, because you really have to ask yourself, are you buying into a generational tech shift?
Yeah.
Or are you just providing exit liquidity for the smart money?
Exactly.
Because when you see a PE ratio pushing 227, it means the market is pricing in a flawless future.
Yeah.
Investors are paying this massive, eye-watering premium today for growth that hasn't actually happened yet. You're basically paying for perfection.
You are. And that tension is exactly what we need to unravel today. Because with Nebius Group, the surface-level numbers tell one extremely loud story. But the underlying operational mechanics, like the actual nuts and bolts of what they are building, they tell a completely different one. We have to look past those headline multiples and figure out what is actually happening inside their data centers.
Let's do exactly that. Let's open up the ledger and pivot to the fundamentals. Because as an analytical skeptic, I have to be brutally honest with you. Looking at their 2024 earnings, it is an absolute bloodbath.
It's definitely rough on paper.
Rough is an understatement. We are talking about an earnings decline of 236.81% year over year. Down 236%, and you would need one of their own supercomputers just to calculate how fast they are burning through cash right now.
Well,
every single dollar they pull in just seems to be aggressively funneled right back out the door into these massive capital expenditures. CapEx is just eating everything. There are no dividends. There are no share buybacks to reward you, the stockholder. It feels like a bottomless pit of infrastructure spending. So justify this for me. What does this massive cash burn actually mean for the shareholder who's holding the bag?
okay, I get it. You're looking at that cash burn as a pure liability, which is exactly the trap a lot of short-term traders fall into right now. But in the AI infrastructure space, massive CapEx is actually the ultimate barrier to entry.
A barrier to entry.
Yes. We have to understand why this cash is being burned at such a historic rate. Nebius Group isn't just buying a few servers and racking them up in a leased closet somewhere. They are executing massive global GPU deployments across Europe, North America, and Israel all simultaneously.
Right.
They are securing land, multi-year power contracts, and liquid cooling infrastructure on 3 different continents. That is not cheap.
Okay, so they are building a global footprint from scratch. But the cost of these next-generation GPUs alone, plus the cooling systems and the energy, it is astronomically expensive. At some point, the music has to stop, right? You can't just burn cash forever.
It is incredibly expensive, yes, but that brings us directly to their competitive moat. And this moat is really the core of their entire $22 billion valuation. Nebius Group has a very deep, sophisticated engineering heritage stemming from their Yandex roots.
Yeah, the Yandex connection is huge.
It changes everything. Because of that specific background, they do not just rent out bare metal GPUs the way a lot of their hardware-focused competitors do. They offer a comprehensive full-stack platform, and they have these distinct subsidiaries that integrate directly into the ecosystem. You've got 1010 in EdTech, you've got Avride in autonomous driving, and Toloka handling AI data services.
Wait. I am not letting you off the hook that easily. Building an autonomous driving company is a massive cash furnace all on its own.
It is, but
How does burning more cash in a self-driving car subsidiary fix the cash burn on their AI infrastructure? To a skeptic like me, that sounds like 2 bottomless pits, not a flywheel. Why does a cloud computing company need an EdTech wing or autonomous vehicles?
because it creates an internal self-sustaining ecosystem. Think about it. Autonomous driving, for example, is incredibly compute intensive. It requires billions of simulated miles to train those models. By having a read in our house, Nebius Group has an immediate, massive anchor tenant for their own computing power.
Oh, I see.
Right, they are essentially their own best customer while they scale up. And then you look at Toloka, which provides end-to-end data services. This means Nebius isn't just handing external developers raw computing power to train an AI. They are giving them the exact tools to label, sort, and process the data before it even hits the GPUs.
Okay, and Triple Ten.
Triple Ten is literally training the next generation of engineers to use exactly these tools. It is a brilliant closed-loop system.
All right, so they are basically building the highway, owning the trucking company that drives on it, and running the gas stations along the way.
That's a great way to put it, yeah.
It sounds great in a pitch deck, sure. But they are not operating in a vacuum. You still have absolute giants in this space. You have direct competitors like CoreWeave who are also aggressively building out compute capacity and locking up all the GPUs they can find. Why would an enterprise customer choose Nebius over them?
This is where it gets incredibly compelling. The ultimate defense Nebius Group has against competitors like CoreWeave is their software integration. They boast a sticky 100% software attach rate for their AI cloud.
A 100% attach rate, meaning literally every single customer who rents their hardware is also paying for their software layer.
Right.
There are no pure hardware rentals at all.
None. Zero. Think of it like Apple's ecosystem. If you just rent a raw GPU from a competitor, you are basically buying an Android phone. You have to figure out all the software orchestration, the job scheduling, the networking, all by yourself from scratch.
Right at the headache.
Exactly. Nebius is giving them iOS. When you come to Nebius for compute, you are natively integrating into their proprietary orchestration and management software. Once developers build their AI pipelines on Nebius' software, moving to CoreWeave would mean rewriting months of code. They'd have to reconfigure their entire workflow.
The switching costs would be insane.
Exactly. That is why they never leave. That 100% attach rate drives up their average selling prices. They aren't competing in a race to the bottom on hardware rental prices because they are selling a premium integrated ecosystem.
Okay, a 100% software attach rate sounds fantastic in theory. But when I look at the actual charts, the stock is giving people absolute whiplash.
Yeah, it's been a wild ride.
All right, stepping away from the balance sheet, let's move over to the technicals and see how this is actually trading. Because the price action right now is wild. Looking at the data from March 2, 2026, the stock was trading at $90.01. The daily range was tightening up between $85.69 and $91.38.
Very tight for that specific day, yeah.
But here's the crazy part. If you zoom out to their 52-week swing, this stock went from a multi-year low of just $18.31, exploded all the way up to $141.10, and is now corrected back down to the 90s.
That is a staggering amount of volatility. I mean, going from $18 up to $141 and then just giving back 50 points to settle around 90. If you are holding this in your portfolio, that kind of price action easily shakes out a lot of retail investors who just don't have the stomach for it.
It really does. Retail panic sells the dips. And if you look at the recent pre-market declines, it is heavily influenced by the broader sector, not even their own internal news. I read a headline recently that called the stock's recent price action something that literally defies logic.
I saw that one too.
And a lot of that erratic movement seems to be tied directly to peer earnings. CoreWeave puts out a quarterly report, and suddenly Nebius Group stock is dropping 5% in the pre-market before the opening bell even rings.
Well, that sympathy movement is incredibly common in emerging high-growth sectors. The broader market often treats all AI infrastructure plays as a single monolith. They see a hardware competitor stumble, and they automatically assume the whole sector is sick.
Right, they paint them all with the same brush.
Exactly. But if you look past the daily retail panic and look at the underlying flow, the volume is telling a very specific, much quieter story. On that March 2nd date, we saw volume hit 11.05 million shares, which is tracking very steadily near its 12.70 million average.
So it's heavily traded. It's highly liquid.
Highly liquid. And while the stock is testing that psychological resistance right near that 91 mark, basically struggling to break out from this recent pullback, there is serious momentum building beneath the surface. We are seeing sustained whale alerts on the institutional side.
Okay, whale alerts.
Yeah, the options flow is extremely heavy right now, pointing toward large institutional players positioning themselves for an upward move.
Hold on, let's break that down. For anyone listening who hasn't spent years staring at a trading terminal, what does heavy options flow And these whale alerts actually tell us, in plain English.
It tells us what the smart money is doing while everyone else is distracted. Whale alerts trigger when massive multi-million-dollar trades execute. When you see elevated options volume leaning bullish, combined with steady share volume near the averages despite crazy daily volatility, it indicates that institutional funds are quietly and methodically accumulating shares.
While retail is freaking out.
Exactly. They are buying the dips that retail investors are panic selling.
So the charts show momentum, but let's shift to the sentiment. What is the street actually saying right now? Because looking at the financial media, it is a complete tug of war. The mood is mixed, maybe leaning slightly bullish overall, but the narratives are wildly polarized. In late February alone, we saw two completely contradictory stories dominated the conversation, published on the exact same day.
The media loves a polarizing story. Let me guess, one narrative calling for the end of the AI revolution and the other calling Nebius the next trillion-dollar company.
You nailed it. On one side, you have headlines literally screaming, "Sell before the AI bubble bursts." And right next to it, you have analysts putting out research pieces titled, "More Than GPUs, a Hidden AI Platform the Market is Missing." You also have op-eds like, "Don't Let the CapEx Scare You," which tries to soothe investors about the cash burn, positioned right alongside articles debating whether their massive contracts will ever translate into actual free cash flow. It is exhausting for an investor trying to find the signal in the noise.
It is exhausting, but this is a classic battle of time horizons. The bearish sentiment is almost entirely focused on the short-term macro environment. Fears of a literal AI bubble, fears of spending too much money today, fears of high interest rates. But the bullish sentiment is looking at the structural, multi-year advantage. They're looking at that 100% software attach rate we talked about, the gigawatts of power capacity they are securing for the next decade. And if we look at what institutions are actually doing with their capital, rather than just what the headlines are screaming, it strongly validates the bullish side.
You're talking about the Q4 2025 institutional data.
Yes. In the fourth quarter of 2025, we saw major institutional moves. Specifically, Alger CCAV was spotted aggressively accumulating the stock.
Just to pause really quick, who is Alger CCAV and why should the listener care that they are buying?
Good question. Alger CCAV is a major institutional fund known for taking highly convicted positions in aggressive growth stories. When funds of that massive size move in, they aren't day trading the 5% pre-market swings. They are anchoring for a multi-year run. This lines up perfectly with those whale alerts we just discussed in the technicals. Institutions do not typically build massive quarter-over-quarter positions in companies they believe are about to get wiped out by a bursting bubble. They are looking right past the current 236% earnings decline and positioning themselves for the revenue inflection point.
And that brings us to the speculative catalysts, the rumor mill that is undoubtedly driving a lot of this institutional options flow. What is the current chatter that has these funds accumulating shares so quietly?
The biggest, most impactful rumors right now revolve around shifting customer financing and massive unannounced enterprise contracts.
Financing.
Yeah. In the AI infrastructure space, securing the power capacity and physically acquiring the GPUs from manufacturers is really only half the battle. The other half is financing billions of dollars of hardware. There is massive chatter right now that Nebius is restructuring how these global deployments are financed, shifting more of the upfront capital burden directly to the end customers.
Oh, wow, that would be a game changer. If Nebius isn't the one carrying all the debt for the hardware on their own balance sheet, it completely rewrites the free cash flow equation. They transform from a hardware buyer taking on all the risk into a high-margin service provider.
Precisely. It drastically improves their risk profile. Furthermore, we are seeing competitors like CoreWeave hitting some very public operational and financial struggles recently. The rumor mill strongly suggests that CoreWeave's stumbles are creating a massive vacuum in the market right now.
So customers are jumping ship.
Allegedly, yes. Enterprise-level customers who need absolute guaranteed uptime, massive scale, and secure data handling are looking at Nebius Group as the much more stable, full-stack alternative. Nebius is perfectly positioned to capture the market share that their peers are currently fumbling.
We've heard the upside. We've heard the rumors. But let's flip the script and dive into the bear case. Because as much as the full-stack ecosystem and the institutional accumulation sound incredibly promising, you cannot ignore the macro environment. The biggest threat hanging over Nebius Group, and really this entire sector, is the AI bubble.
The overarching fear that the music is finally about to start.
Exactly. What happens if the AI adoption cycle slows down? And I don't even mean a total collapse, just a plateau in enterprise demand. Nebius Group is plowing billions of dollars into capital expenditures, building these massive data centers across 3 continents. If demand cools off even slightly, that massive capex turns from an aggressive growth strategy into a crippling free cash flow trap. You end up with warehouses full of rapidly depreciating supercomputers that nobody wants to rent. It is the ultimate nightmare scenario.
It is. It is the classic boom and bust cycle of commodity hardware. If you overbuild and demand falters, you are left holding the bag on billions in depreciating assets.
And it is not just their own fundamentals at risk here. There is the very real danger of guilt by association. We already talked about how the stock moves violently based on peer earnings. If a major player like CoreWeave misses their earnings, Nebius gets dragged right down with them in a wave of sympathy selling.
Yeah, the market doesn't always differentiate.
Right. The market might just collectively decide that AI infrastructure is dead and sell off the entire sector, completely ignoring Nebius's 100% software attach rate or their deep engineering heritage. For anyone listening who hasn't lived through a tech crash, multiple compression basically means the market stops paying a premium for a stock. So even if Nebius keeps growing its revenue, if investors decide a 226 PE is simply too rich for the current environment, the stock price could completely crater anyway, right?
That is a very fair, very sobering assessment of the risks. The threat of a broader sector rotation is incredibly real. If the market shifts away from high-growth tech and moves to defensive stocks, the multiple compression on a stock carrying a 226 PE ratio would be violent. You would see the stock price plummet even if the company's internal metrics remained healthy. However, this is exactly where we have to look at the unique defense Nebius has built against these exact doomsday scenarios.
Okay, so how do they actually survive if the bubble pops? Give me the structural defense.
They survive in 2 distinct ways. First, those recent shifts in customer financing we just talked about. If the rumors are true and they are successfully shifting the massive financing burden onto the enterprise clients who are locking in long-term, multi-year contracts, it incredibly de-risks Nebius's balance sheet.
Right.
They aren't left holding the bag on billions in hardware debt if a client suddenly decides to slow down their AI development. They have already locked in the revenue before they took on the liability.
So they essentially make the customer pay for the house before they finish building it.
Exactly. And second, that full-stack software moat provides a massive buffer that mere hardware rental peers simply do not have. If you are just renting out raw GPU access, you are selling a pure commodity. And history tells us that when demand drops, commodity prices crash in a race to the bottom.
Because everyone just undercuts each other on price.
Exactly. But Nebius is selling an integrated platform. They are deeply embedded into their clients' daily workflows. Even if an enterprise client reduces their overall compute usage during a macro downturn, they are highly unlikely to rip out the entire Nebius software ecosystem and migrate their pipelines to a new provider just to save a few pennies on raw compute.
The switching costs protect them.
Yes, the switching costs are astronomically high. That software stickiness protects Nebius's margins even when the broader hardware market is crashing.
All right, we've weighed the data, the charts, and the risks. We have looked at the massive, terrifying cash burn weighed against the brilliant full-stack moat, and we've contrasted the extreme retail volatility against the quiet institutional accumulation. Let's get to the final verdict on this one.
When you synthesize all of this, the brutally poor short-term fundamentals against the massive technical momentum, the polarized market sentiment, and the very real macro risks, we were looking at a definitive bullish score of 8 out of 10.
An 8 out of 10. That is a very strong, highly convicted score, especially considering we were talking about a company with a 226 PE ratio and a 236% earnings decline.
It is a strong score because the multi-year investment thesis is remarkably clear once you look past the daily noise and the retail panic. Nebius Group is an undervalued AI infrastructure leader masquerading as an overvalued stock. Yes, the CapEx numbers look absolutely terrifying right now, but those fears are largely overblown when you understand the scale of what they are building.
Yeah.
The risks are heavily mitigated by the shifting dynamics in customer financing and, most importantly, by that brilliant 100% software attach rate. They aren't just participating in the AI hardware boom. They are methodically locking their enterprise customers into a high-margin, sticky ecosystem.
So you see this strictly as a long-term play. You were telling the listener not to trade the daily swings.
Absolutely. This is a multi-year hold. It is designed to ride the massive secular wave of the AI adoption cycle. If you are going to hold Nebius, you have to be able to stomach the volatility. You have to accept the short-term earnings hits as the necessary cost of building global empire. But the underlying mechanics show a company that is uniquely structurally positioned to dominate the next phase of cloud computing.
A full-stack giant, quietly building the future, while everyone else argues over the price of a single GPU. I love that perspective. But here is something provocative to chew on before we go, something that nobody in the financial media is talking about yet. If Nebius successfully builds the ultimate infrastructure for AI, and these models get smarter and smarter, what happens when AI becomes so incredibly efficient that it no longer needs massive, sprawling GPU clusters to run? If software optimization outpaces hardware needs, are these massive global data centers the vital railroads of the future, or are they destined to become the next ghost towns?
Now, that is the ultimate long-term question for the entire sector.
It really is. So what do you think of that 8 out of 10 score? Are you looking at Nebius Group as the ultimate foundational AI infrastructure play, or does that massive capex and the threat of multiple compression still keep you up at night? Let us know your thoughts in the comments below. And as always, remember to subscribe, like, and comment on this video to support the channel. It really helps us keep bringing you these deep market breakdowns. Until next time, keep doing your research, ignore the noise, and stay curious.